When you set some of your modeling in your forecast, what's your oil price? I know it's a range, and I know it's very difficult to predict, especially when OPEC Plus find an agreement, and yet the price actually falls.
Yeah, we're looking for an average oil price this year of $60 per barrel on the WTI. And I don't mean to blow my own trumpet, but last year the average was 65, which was happened to be also our prediction. And often we imprint on the higher numbers, so that's why I wanted to mention last year's 65, because people might not be aware that the average was actually that low.
Okay, but what does it mean? I mean, going forward, if you look at the last 4 to 5 recessions, they were either directly caused or impacted by a shock in the price of oil. Is this time different?
Well, I think that fundamentally the dominant factor in the oil market is obviously U.S. shale, and therefore this oversupply of oil is what we're focusing on the most. Although, of course, we're completely aware of geopolitical risk and things that could happen to cause oil price spikes, but we don't think that they will last, which is how we come up with our average prediction of $60.
Okay, Elsa, what does this all mean for your world of currencies?
So it's interesting because currencies that have typically had a very strong relationship to oil, I'm thinking of CAD in particular, have actually seen that relationship weaken a little bit. And part of the problem for Canada is how much of the oil is just trapped in Western Canada in the oil sands with no pipeline capacity to get it down to the markets where it could be sold. So as a result of that, we've seen the Canadian dollar trade actually much more of 2-year rate spreads or the economic data in Canada rather than underlying crude prices.
Okay, when does that change?
So I think it'll start to change as you begin to see more pipeline capacity coming online. We were hopeful that would start this year. It actually looks like it's more likely to be a 2020 story. There are still petrocurrencies out there. Ruble obviously does very well on the back of oil. It definitely helps finances for a number of countries, including Mexico and so on. But at the end of the day, in G10 space, it's actually less of a driver than perhaps once was.
Okay, if we cross over into the world of Fed, so this is not the kind of inflation that they're looking for, but it's kind of linked, tenuously to the price of oil. But when are we going to see inflation? Is it going to be back? We had Loretta Mester of the Cleveland Fed yesterday, right here on the set, and she was saying, look, inflation's coming back. I don't want to cut just yet. Is she right?
Well, yes and no, sort of a typical economist answer, no, it depends. But I think, again, the dominant factor in the inflation space is the technological revolution and the disinflation that brings about, which has obviously seriously impacted goods prices. And I would think that in the coming 25 years, it's going to feed in also into service prices, which have not benefited from this disinflation so far. So fundamentally, I think that we're going to continue to live with, compared to history, very low rates of inflation going forward, and probably for some 20, 25 more years. But that doesn't exclude the possibility of having a temporary pickup in inflation, but not much beyond the central bank's targets.
What does that mean for dollars? Dollar too strong?
Inflation is an interesting one because it's something that economics would tell you is supposed to be bad for a currency. But actually, in G10 space at least, we find that it's very good for a currency because when you do see a pickup in inflation, you anticipate that the central bank is going to respond to it. So what does this mean for the dollar? Well, the fact is that you still have much better prospects of inflation or lower prospects of disinflation in the US than you do, say, in the euro area or Japan and other countries. And therefore, as a result, it's hard to see the dollar selling off radically if the Fed's not going to be able to slash rates. You need a recession. You need something more meaningful to get rates back towards zero, which would then trigger a much more meaningful correction in the US dollar.